G'day folks, welcome back to another update for your high-grade copper and US crude oil. Now both charts are showing bullish momentum on the daily charts. We'll go through the different time frames, but also do some back testing. And before we go any further, make sure you hit that like and subscribe button to support the channel, that'd be great. Also reference the +1 videos where we'll do a deeper dive into various trading strategies. Just try and find the +1 videos. Some are attached in the description below. The link's in there. In terms of the outlook, I won't read through all this in detail other than to say copper remains supported by electrification boom, EV growth and grid investment, but faces risks from weak Chinese demand and smelter overcapacity. Supply disruptions keep the market tight. For US crude oil is more balanced with rising non-OPEC output and potential oversupply pressuring prices, while demand is steady but vulnerable to economic slowdowns and policy shifts. Overall, copper leans bullish on structural deficits, while oil holds a range-bound to mildly bearish bias. That's according to their analysis. So looking at high-grade copper first on the weekly, we always look at the long-term trends, and we've got the price still below the moving averages, and so is the CCI broken into that moving average range of the CCI moving averages. That's somewhat of a neutral positioning, I'd say, or more bearish on the weekly. However, on the daily, you can see there it's broken above the moving averages of the price, but also the CCI150. That's a bearish momentum from that arrow onwards, and you'll be taking long trades if you're trading on the hourly. So we always trade in the direction of the higher time frame. So in this case, if you're trading on the daily, we wait for the weekly to break into a bullish mode before going long. Otherwise, if you're trading on the hourly, we go in the direction of the daily. And as I said, we go long from that period there. But what we do as well, even if you're trading on the daily, we look at the lower time frame, the hourly in this case, to see if there's any micro moves. And what we do working backwards, you can see here what we look. The first thing we identify is any divergence, and that's you can see there the price has fallen below the moving average band, and so is the CCI. But notice here we had a bearish divergence from the same period on the price, higher highs on the price versus lower highs on the CCI. That's a bearish divergence, and what we do is we draw then a Fibonacci retracement from that high. We take it back to the significant low before that divergence started, and we aim for a minimum retrace between, let's go from that level there, between a 23-38% as a minimum retrace. In this case, it fell down to the 50% level and it's currently stabilized at the 50% retrace. Now that's a minimum. Now I don't trade these divergence. It's a bit risky because we don't know when it's going to start pulling back and we don't know how far it's going to go. Our trading strategy is basically moving in line with the moving averages of the price and the CCI. So you would have gone long at that point on that candle, and you would have done quite nicely and closed it out probably on that little range there and made those few pips. The CCI was showing a decline, and eventually the price did fall off. Now you could have let it go in and close it out at that candle there on the price, but it doesn't always work that way. Usually the CCI gives you an early warning to get out of the trade. Now looking at so it's somewhat bearish at the moment on the hourly, but again, if we go back to the back tests, looking at the daily, going long from the daily perspective, when the CCI and the price are above the moving averages, you would have taken long trades along on the hourly if you're trading the hourly. Now notice here as well, we go in a direction of the price moving averages and the CCI. And at the very latest on the daily, whenever the daily touches that moving average range on the CCI, you would have taken, at the very latest, you would have closed out and stopped your positions if you're in long positions at that point there. But before that, you would have noticed as well these points where the moving averages, and I'd like to keep it, you notice here I'm zooming out, I'm not zooming in too closely. As soon as you start seeing the moving averages bend down on both the CCI and the price, you would have closed out your positions at that point there. And you might have had a position open, but you would have saved that drawdown at that point. Gone long again at that point when the price and the CCI are above the moving averages. You would have started going long at that point, and again closing it out when the price and the CCI were in a decline there. That's basically the strategy when you're using the CCI and the price moving averages. Up until, as I said, more recently, you would have opened up another position there, you can see there, and then close it out the very latest when the CCI hit that range there. Now what this strategy does, again, is various strategy you can use. I like to get out with a small 0.3% gain, and that's why, for example, you can see these little bars there, that they're each individually going long. Up until that point, they go for a 3% gain and then get out of the trade, rather than waiting for the indicator to turn down. But you can do either way. Next we have US crude. So on the weekly, first off, you can see there the price is just broken above that moving average on the weekly. The CCI is still in that moving average band, so somewhat neutral positioning at the moment. The price is pretty much consolidating in that range now for a few months. So not a strong indication of bullish movement at the moment on the weekly. On the daily, however, we've actually broken up in the last few days into a bullish mode, although notice we might be coming back with a bit of a retrace, and I'll show that in the hourly in a second. But basically on the daily, we also look for any divergence, and there's no real obvious divergence that you can notice there. Again, bullish momentum at the moment on the daily CCI, but also the price. Now notice also on the price, that moving average band is still declining. The red is above the blue line there, and what you want to see, you can see there, that was a bearish momentum here, back here with the red above the blue. There's a bit of a bullish move there. That quickly broke down. So since then it's been consolidating. So even though the price is above the moving average band, that moving average band is still somewhat, I'd call it bearish on the daily. On the hourly, however, we've had a nice bit of a bull run here in the last few days, and currently it's weakening. You'll notice there as well, we've got a bearish divergence. So even you got higher highs on the price. That peak there on the CCI is a slight decline from that peak there, so that's a bearish divergence. And if that was to pull back, we draw a Fibonacci, you'll take it back to that significant low, and we expect the price to pull back as a minimum. Assuming it does pull back, it may not come back to the 23-38% range, and that coincides with his previous resistance, which is now a support at 63.83. So we might see it pull back to there. Again, I don't trade these divergences. If I'm going long during this period and I start noticing a divergence, I get out of any long trades, and that's my indicator to exit the trade. That's where I use the divergence. So that's a potential retrace we can expect. Of course, the price could keep going higher. So long as the price rises and the CCI drops, we're going to consider it a bearish divergence. Now on the back test, first off, going back from this period around about the 5th of August on the hourly, based on the daily trend. Now notice here, that's what I'm talking about, the CCI being an exit point. Notice there that CCI broke into the moving average band at that point, right near the low there on that candle, and that was an early warning exit, and you would have got out of that short trade, and that coincided, and that was on the 19th of August, that coincided with this period back here, and you would have been up about, in this case, you're trading $10 contracts, you would have been up about $19,000 in trades. However, you would have also probably closed out your positions based on any bullish divergence, and that's, let me try and see, there's no real bullish divergence there, but again, when you see this, the CCI and the price bending up, you would have closed out your positions in each one of those and then re-enter short trades when the CCI and the price were breaking to the downside. Again, closing it out to the long position there, you would avoid that little drawdown and then re-enter it again at that point there, until such time it enters into that CCI range on the daily, in which case you avoid going long or short. In this case, avoid going long during that period. Why? Because the price moving averages is still declining. So most of the momentum is still on a downside until that point. Now that was a false break, and we had no way of knowing at the time. And we'll look at that point there on the daily, on the hourly. Notice there it broke down quite strongly. So you might have got in with a contract open at that point, but you would have closed it out based on the daily and the hourly breaking to the downside if you're going long. Now in this case, the short positions worked okay with a few drawdowns there, but again, I wouldn't be doing that. I'm just showing you what happens if you do let it go. In this case, it worked out well with a bit of a drawdown, and you would have ended up with a nice little return. However, I'm not suggesting you do that. As I said, currently, if you're going long during this period, you'd be closing it out, paying attention to this bearish divergence. And that's where I've got this other long back test going from this period. If you're trading this on the 1 hour time frame in isolation based on the daily from that candle onwards, and again, you'd be closing it out. I wouldn't have entered those trades there because of this bearish divergence. So if you enjoy the content, subscribe at least on a free trial to my Patreon page, where I publish weekly bullish shares across regions of the world's markets. Thanks, and talk to you in our next video.